What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Friday, everybody. I hope you're all doing well. The weekend is almost here. I have a business trip this evening, and so this episode is going to be a little bit shorter. It's going to come out a little bit earlier, and it's being recorded at work, so it may sound a little bit different, but we'll be back to normal episodes from tomorrow. So let's just dive in. And first up, the situation in Shanghai. Yesterday, the mega city and beating heart of China's economy, Shanghai, announced the discovery of 5 new COVID cases. These cases were not discovered in the outskirts of the city either, but in one of the major central business districts of Shanghai. Local officials say these cases are linked to a People's Republic of China citizen who returned from the United States in late December and tested negative all through the 14-day quarantine period, then was negative during the 7-day home observation period, but then unlawfully left their home on multiple occasions during that home period. Indeed, these cases are linked to a bubble milk tea shop where the person went to get a drink while they were supposed to be at home. The situation in Shanghai is still developing, but officials are likely very nervous. If cases are not brought under control and the city has to lock down, it would be economically devastating. Officials understand this, and as such, it will take a lot before they are willing to pull the trigger on a lockdown on the $500 billion economy. Meanwhile, the other outbreaks that officials are already trying to stamp out continue to spread. The situation in Xi'an seems to be stabilized. It seems to be stabilizing, though people are still in full lockdown. New official cases are in the single digits. However, Tianjin and Henan are still seeing dozens of new cases every day, and restrictions continue to tighten. Of course, all of these numbers are all official numbers, and so we need to take all of these numbers with a grain of salt, obviously, but at the very least we know which regions are the regions of concern. We now have more information too on what looks to be a new Omicron epicenter in the freezing northeast. At a press conference, local officials of the port city of Dalian in northeast China's Liaoning province confirmed that 2 college students returned from Tianjin to Dalian and were found to have the Omicron variant, the same transmission chain as that found in Tianjin. They were both fully vaccinated with the Chinese vaccine. And yet another outbreak center has emerged, this one in the south, around the Pearl River Delta. The southern Chinese city of Zhongshan reported its first local COVID-19 case outside of Shenzhen, which has been dealing with small numbers of cases all this week, and this is part of the current outbreak in Guangdong province. Okay, next up, state media this week is discussing a new plan published by the powerful National Development and Reform Commission and the not-so-powerful Ministry of Water Resources, designed to improve China's deeply concerning water security situation. The plan is the first 5-year plan for water security to be implemented on the national level. According to Beijing, by 2025, China's capacity for flood control and drought relief, utilization of water resources, optimization, allocation of water resources, and ecological protection of water will have been significantly improved. It notes that China will also step up efforts to promote reforms in key areas of water, improve the innovative development of water conservation, and modernize water management systems. We will see how successful these claims are over the next few years, I guess. Water security issues, particularly in the north where water scarcity is incredibly acute, is seen as one of the big 3 threats to Chinese dynamism in the coming decades. The other 2 are debt and demographics. Okay, next up, key economic and financial developments over the last few days. According to Swiss multinational investment bank and financial services company UBS Group AG, residential property values in Hong Kong will fall by around 5% this year, 2022, due to persistent population outflow and imminent interest rate increases. John Lam, head of Hong Kong real estate research at UBS, said in a media briefing this week that restrictions on capital outflows from the Chinese mainland and the country's slowing economic growth may also drag down home prices in the Special Administrative Region. Of course, we've been seeing in recent months a net outflow of expat workers from Hong Kong, particularly expats from developed economies in the West and in East Asia. Several commentators have also pointed out that UBS's bearish position on Hong Kong real estate is shared by other major players like Citigroup Inc. and Morgan Stanley. Indeed, Citigroup predicts home prices in Hong Kong will drop by as much as 10% in 2022. And speaking of housing, let's jump over to the mainland. The Ministry of Housing and Urban Rural Development in Beijing told reporters at a special press conference this week that China would build a total of 6.5 million low-cost rental homes across 40 major cities in 5 years through 2025. According to the ministry, quote, the homes will account for about 26% of new housing supply in the cities and benefit 13 million young people and new residents. End quote. Chinese financial media outlet Tencent Media is reporting this week that China's new payment standards could, quote, shake the duopoly of Alipay and WeChat Pay, end quote. Speaking to quote-unquote industry insiders, Tencent reports that China's new technological standards for unifying digital payment barcodes, quote, have laid the groundwork for tearing down the walls between different payment platforms. But to what extent interoperability can be achieved will depend on how forcefully regulators enforce these non-mandatory provisions. End quote. The piece argues that if strictly implemented, the standards are expected to hit the duopoly of technology giants in the mainland and Financial and Tencent holdings. And last up, Evergrande housing. And like I said, guys, I'm sorry that this episode's a little bit shorter, but I did want to get an episode out for you guys because there have been key developments that we need to keep abreast of, and tomorrow we'll be back to normal. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. A little short-term win for Evergrande today, and a modest bump in stock prices with the announcement that the property developer's main unit, Hengda Real Estate Group, has reached an agreement with bondholders to delay payments for a 4.5 billion RMB, approximately $700 million onshore bond. The good news for the sector ends there, however. Several Chinese developers were hit in the capital markets yesterday with growing concerns about ongoing liquidity issues among property developers, most of which are very heavily indebted. $600 million offshore bonds from Sunac, China's third largest developer, this is SUNAC, due in 2026, slumped to a record low of 46.7 cents on the dollar, with another $600 million bond due in June, dropping to 63 cents on the dollar. Shares followed bonds with a 3.1% drop yesterday. Shimao's shares were hit yesterday too, with its note due in 2027 dropping to 35 cents on the dollar, also a record closing low. Meanwhile, the state continues to march forward into the housing and real estate sectors. We have been expecting this development for some time here on China Update, the soft nationalization of huge parts of the Chinese housing sector, justified by the crisis triggered by private actors like Evergrande. Indeed, Bloomberg published an article today entitled, China's property market is set for state-dominated age of rust. The piece expressed that China watchers have begun sketching out a likely future for the real estate market that looks far different from its more than 2-decade run of supercharging economic growth, household wealth, and government revenue. This is the wordings of the article. Quote, in short, the days of blistering home price gains and debt-fueled building sprees by billionaire property tycoons are set to fade. They'll be replaced by a much more staid market where authorities are quick to clamp down on speculative frenzies and development is dominated by state-run companies earning utility-like returns. End quote. The piece quotes a founding partner of a Beijing-based bond fund as expressing, quote, if we call the past decade a golden age for the real estate industry, it is now trapped in the age of rust. End quote. Respected Washington-based China analyst Bill Bishop observed today, quote, It sounds like the SOEs are going to be the big winners from the real estate mess, and if through these moves they can ensure that projects that have already been paid for are completed and no one hits the streets to protest, not getting their apartments, then to Xi, this will be further confirmation of the key stabilizing and control role that big state-owned enterprises play. I am old enough to remember when Beijing was telling the central state-owned enterprises to get out of the real estate business, but that was in a different era." End quote. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.